Hello, XRP Army, and welcome back to the Crypto Republic, your go-to channel for the latest technology updates in digital assets. Before we get started with today's business, make sure to smash that like button, ring that bell, and subscribe to the Crypto Republic, bringing you updates every day at noon and 7:30 Eastern Standard Time. Just a reminder, this video is for educational purposes only. This is not financial advice. Always do your own research before making any investment decisions. Something unusual is happening. While fear spreads across the crypto market, while headlines focus on geopolitical tension, and while investors watch XRP and HBAR trade near levels many thought they'd never see again, something else is happening beneath the surface. Capital is moving, not disappearing, moving. And throughout financial history, whenever capital rotates from one asset class to another, fortunes have been made by those who understood the shift before the crowd. The question is simple. Are we witnessing the final stage of a crypto capitulation or the early stages of one of the largest repricing events of this cycle? Let's break this down. Right now, the crypto market finds itself in a strange position. Bitcoin remains under pressure. Altcoins continue to struggle. Sentiment is weak. Retail participation is low. And yet the stock market has been doing the exact opposite. The S&P 500 continues pushing higher. The NASDAQ has experienced extraordinary gains. Artificial intelligence stocks have exploded. Certain companies have risen hundreds of a percent in remarkable short periods of time. Now, this is what most people miss. Money has not left risk assets. It is simply concentrated into a very small group of assets. Instead of flowing broadly across financial markets, capital has crowded into a handful of dominant technology names. This has created a powerful divergence. Stocks are celebrating, crypto is suffering, but divergences rarely last forever. And history suggests that periods like this often end with capital rotating towards assets that have been left behind, including cryptocurrencies. One of the largest drivers of current market weakness is geopolitical uncertainty. Tensions between the United States and Iran have increased market anxiety. Investors are becoming increasingly concerned about energy markets. Oil prices have become more volatile. Global trade routes remain vulnerable. And whenever uncertainty rises, markets naturally shift towards safety. Let that sink in. Write that down, ladies and gentlemen. Super important. That's something you should always remember. This is known as risk-off environment. During risk-off periods, investors typically reduce exposure to speculative assets. That includes cryptocurrencies. The result, selling pressure, reduced liquidity, lower prices. But here's where it gets interesting. The market often overreacts to geopolitical events. Fear can create temporary distortions that have little impact on long-term fundamentals. Price is reacting, but the system's evolving. That distinction matters because investors who confuse short-term volatility with long-term structural change often make costly mistakes. Short-term noise, long-term structure. Those are two very different things, ladies and gentlemen. To understand what may happen next, it's worth looking back. Everybody here knows I love my history. In 1973, the world experienced one of the most significant energy shocks in modern history. The oil embargo triggered massive uncertainty. Energy prices surged. Economic growth slowed. Financial markets became highly volatile. At the time, many investors believed the disruption would permanently reshape global markets. But eventually, capital adapted. New investment opportunities emerged. Liquidity returned. Markets stabilized. And investors who focused on long-term structural shifts rather than short-term panic were ultimately rewarded. Today, while the circumstances are different, the psychological pattern remains remarkably similar. Fear dominates headlines. Investors become defensive. Yet beneath the surface, capital quietly surfaces and searches for the next opportunity. And that opportunity may increasingly be found in digital assets. Write that down. Let's talk about the elephant in the room, ladies and gentlemen, the stock market. Many investors assume that because stocks continue rising, they must continue rising indefinitely. History suggests otherwise. Markets move in cycles. Periods of enthusiasm are followed by periods of consolidation. Periods of excess are followed by periods of normalization. Some sectors have experienced extraordinary gains over the last year. Valuations have expanded dramatically. Expectations have become increasingly optimistic. And when expectations become too optimistic, markets become vulnerable, not necessarily to a crash, but to a pause, a correction, a rotation. And that's the key word, rotation, because money rarely leaves the system entirely. Write that down. It simply moves to where it believes future returns will be the greatest. So, for crypto to experience a major repricing event, 3 conditions may need to align. Condition 1, a slowdown or correction in equities. This would encourage investors to look elsewhere for opportunity. Condition number 2, improving liquidity conditions, specifically Federal Reserve policy. Many analysts continue watching for future rate cuts, lower rates generally, increasing liquidity. Increased liquidity tends to support risk assets, including cryptocurrencies. Condition 3, crypto-specific catalysts, institutional adoption, new ETF developments, blockchain integration, tokenization, enterprise usage. All of these factors can attract fresh capital. When all 3 conditions align simultaneously, capital flows can accelerate quickly. And that's exactly why many investors remain focused on XRP and HBAR, baby. Think about the Roman Empire, ladies and gentlemen. Rome didn't become powerful simply because it had armies. Rome became powerful because it built infrastructure, roads, trade routes, communication networks. The roads themselves weren't always exciting, but they enabled everything else. Modern blockchain infrastructure may be similar. Projects like XRP and HBAR are not necessarily being valued solely for speculation. Many investors view them as infrastructure, systems designed to facilitate futuristic and future economic activity. Like Roman roads, the true value may emerge when the network effects mature. And that's why some market participants focus less on today's price action and more on long-term adoption, because infrastructure often becomes most valuable after it's already been built. Now let's zoom in on XRP specifically. One of the most important technical developments currently being watched is the 200-week simple moving average. For decades, long-term moving averages have been among the most respected indicators in financial markets. Why? Because they help identify major trend zones, not exact bottoms, not exact tops, but areas where risk and reward become increasingly attractive. Historically, when major cryptocurrencies approach their 200-week moving averages, long-term investors begin paying attention. And XRP is approaching precisely that kind of level, around the $1.10 region. Now, this does not guarantee a reversal. Nothing guarantees a reversal. But it does place XRP within a zone that many investors consider strategically important, which explains why accumulation conversations have intensified. Ladies and gentlemen, the same logic extends to HBAR. HBAR continues attracting attention because of its enterprise-focused design, institutional partnerships, governance structures, scalability, transaction efficiency. These characteristics have helped establish HBAR as one of the most unique projects within the digital asset ecosystem. Now, this is what most people miss. Markets often price narratives before they price fundamentals. Then eventually they price fundamentals. And when that transition occurs, repricing can be dramatic, ladies and gentlemen. Let that sink in. Patience. It pays to be patient, ladies and gentlemen. Whether HBAR ultimately experienced that outcome remains uncertain, but the infrastructure thesis remains one of the primary reasons long-term investors continue monitoring the project. Another useful example comes from 2008. The global financial crisis created widespread panic. Investors sold assets aggressively. Confidence collapsed. Many believed the financial system itself was breaking. Yet what followed? One of the largest liquidity expansions in modern history. Central banks introduced extraordinary measures. New monetary policies emerged. Risk assets eventually recovered. And entirely new industries flourished. The lesson isn't that today's environment is identical. It isn't. The lesson is that major periods of fear often create opportunities that become obvious only in hindsight. And that's exactly why investors continue watching liquidity so closely today, because liquidity remains the lifeblood of financial markets. Ladies and gentlemen, there's another historical analogy worth considering. During the California gold rush, many prospectors searched for gold. Some became wealthy, most did not. But the businesses supplying tools, transportation, and infrastructure often generated more consistent success in many ways. Blockchain infrastructure projects resembles those suppliers. Rather than betting exclusively on one application, they provide the rails upon which future applications may operate. Again, that's not a guarantee of success, but it helps explain why institutional investors increasingly focus on infrastructure rather than speculative alone. So where does that leave investors today, ladies and gentlemen? Many are choosing patience rather than chasing momentum. Rather than buying during euphoria, they are gradually accumulating during periods of pessimism, through dollar cost averaging, through disciplined positioning size, through long-term planning. This approach acknowledges uncertainty. No one knows exactly when capital rotation will occur. No one knows exactly when the next major catalyst will arrive. But many investors believe positioning before the crowd may offer a more attractive risk-reward profile than reacting after prices have already moved. That philosophy has existed for generations. But when attention is low, remain patient. Gucci conviction, Gucci clarity. Do not get caught up like sushi, ladies and gentlemen. This is where you got to keep that frosty mindset, ladies and gentlemen. Allow time to work. As we step back and examine the bigger picture, fascinating possibility emerges. Geopolitical uncertainty has created fear. Capital is concentrated in equities. Crypto sentiment remains depressed. Yet beneath the surface, the ingredients for a future rotation continue developing. A stock market pause, potential liquidity improvements, growing institutional adoption, infrastructure expansion, and historically significant technical levels. Whether the repricing arrives next month or next year remains unknown. But this setup is becoming increasingly difficult to ignore, because throughout financial history, the largest opportunities often appear when confidence is at its lowest. Short-term noise, long-term structure. Prices reacting, systems evolving. I always say pay attention to what's quiet, ladies and gentlemen. And that may be the most important story unfolding in crypto today. If you enjoyed this analysis, make sure to subscribe and join the Wolf Pack. Hit the notification bell and leave a comment below. Do you believe XRP and HBAR are approaching a historic accumulation zone? Or do you think more downside is still ahead? Let me know. I'll see you in the next video. Well, ladies and gentlemen, happy Friday. Hope everyone had a blessed day with what's going on. I want to welcome all the new members of our Patreon, the Crypto Public Just Monthly, all the new members in the membership channel. If you see what happened today, I'm going to be quick with this because this is super important. Quick with this because most people are feeling some form of panic. You have to be excited for these situations. And whatever you want to call them and why, the most important thing here to understand is this. Finance is war. Plain and simple. Being a financial mercenary is a lifelong quest. You will do this job every day of your life. Good days, bad days, red day, green day, hallelujah days, oh my God days, rip your face with rally off days, getting chopped up like sushi days. You learn to do the same thing over and over again. You learn to understand. I told you this morning about DXY, that was pushing higher. I told you what would happen with gold. If gold cracks down here and it closes below 4,300, it closes below that on a daily chart, you'll look at 4170 in range with that. If it bounces here, it could go up to 4,400. A lot of the market's being moved by Bitcoin. I'm not going to go over that. And everyone in our premium section in the Patreon, the Crypto Public Does Monthly, understands where it's going off of that. The market's keying off of that. Also, the strong job numbers puts interest rates back on the table. Again, we're not in that camp, but the rest of the world believes that. We kind of buck the trend. That's why we like to run across traffic in rush hour traffic. But again, the family offices that retain us, they want not groupthink. They want to know what's happening. They don't want to be told what they want to hear. It's a very big difference of a story. So if you look, one of the big things that we think is happening right now is we believe that the SpaceX IPO and other IPOs that are coming out are actually sucking liquidity out of certain markets because people want to have a taste of that. They do. They don't want to miss out on that. If you think about what's happening, everybody's all down and out right now. XRP, oh my God. I love XRP, the anointed one. I have never been more excited. If you went back to 2013 and you looked at the top coins in 2013, XRP would be number 3, baby. Go back and look at 2013 and the top coins. XRP is number 3. After that are all kinds of weird name calls that don't exist anymore. Those coins are gone. If you look at today, look at what XRP is. 5th to 6th. If you took out, if you took out Tether, it'd be a little bit higher, right? But again, it stood the test of time. See, when people are given a reason to take profit, they take profit. That's why pigs get slaughtered, hogs get fatter. A couple of videos ago, we told everybody we had closed our Bitcoin longs. We didn't close it at the top. It was still on its way going up top. We would rather take profit, and none of this is financial advice. This is just my own opinion. I don't intend any capacity on the way up. You'll never call the top. You'll never call the bottom. Nobody does. Learning to consistently hit base hits is how you get into the Hall of Fame. Except this game, you're betting everything. So the fact that the market now converges on chaos, potential kinetic activity again in the Middle East, the fear of missing out with certain IPOs. Always tell you that money has got to make its weekly numbers, its monthly numbers, its quarterly numbers. You see that going on right now, okay? Oil is at $90.24 at the time of this recording. Gold is at $4,328. If it doesn't close below 4,300, it could bounce, but it's got to be on a daily chart. If it closes below that, you could look at 41.75. But again, the market's keying off. It's taking profits out of positions and preparing for other plays. Everybody's talking about Zcash. Again, I told you about this in our earlier video. Ladies and gentlemen, the reason that we love XRP, ICP, and HBAR, it's what they do for the future. So when you ask yourself why you're in these moves, I hope that you're under leveraged. I hope you're not even using leverage. I hope that you have a trading plan that you're following. Because if you don't, then you're just hoping to be lucky. This isn't a game about luck, ladies and gentlemen. Finance trading has never been about luck. If you think it's about luck, you're so wrong. Don't get caught up like sushi. You don't get shaken out. Why would you get shaken out here? When you invest for the future, you risk your time because you're risking your money. You realize that? But ladies and gentlemen, one good tip from the pits can easily pay for your entire year subscription. If you want the deeper macro research, you learn how to take advantage of everything that we're talking about, come and join over 560 active traders and investors inside the page on the Crypto Public Desk Monthly, ladies and gentlemen. See, the market's streaming something most people aren't hearing. Everybody wants to talk about Bitcoin. Everybody wants to talk about XRP. Everybody wants to talk about AI, the next altcoin season, the next Fed meeting, the next moonshot, blah, 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 blah. But almost nobody's paying attention to what the actual money is doing. And that is where the biggest mistakes get made, ladies and gentlemen, because markets don't move based on narratives. They move based on liquidity. They move based on capital flows. Write that down. They move based on positioning. And right now, the data is flashing something very interesting. See, this week, Bank of America reported something that should make every investor stop and think. They just saw $120 billion move into cash in a single week. $120 billion into cash. Write that down. At the same time, bonds attracted $39 billion, the largest bond inflow on record. My God, no one's even talking about that. Stock still brought in $23 billion, but crypto, crying crypto saw $2 billion leave the sector. Oh my God, my crypto's down. Ah! The biggest outflow since late 2025. Now think about that. If this is truly the beginning of some unstoppable risk-on environment, why are institutional flows behaving this way? Why is cash attracting over 5 times the capital that stocks are attracting? Why are bonds seeing record inflows? Why are large investors quietly becoming more defensive while retail investors continue chasing headlines and looking to get caught up like sushi and carried out in body bags? Do I have your attention? That's the question that matters, ladies and gentlemen, because the market isn't about what people say. The market's about what people do with money, and money leaves footprints. Those footprints are telling a fascinating story right now. See, you learn on the floor of the Merc as a trader very, very important things. And one of the most important charts in the entire world right now wasn't about crypto, wasn't about AI, it wasn't about technology. It wasn't about inflation, ladies and gentlemen. According to the Bank of America, 46 out of 68 global central banks are currently overshooting their inflation targets. Read that again. Rewind. 46 out of 68. That means the majority of the world's central banks are still fighting inflation, despite years of tightening. The market has spent the last several years believing central banks have everything under control. But what if they don't? What if inflation isn't dead? What if inflation simply paused? Because that's exactly what some of the data is suggesting. Ladies and gentlemen, the report points out that if current monthly inflation trends continue, U.S. inflation could move back above 5% before the midterm elections. And historically, when inflation crosses 4%, the S&P 500 has an averaged a decline of approximately 4% over the next 3 months and nearly 7% over the next 6 months. Let that sink in. That doesn't mean history repeats itself perfectly, but it does mean the risk profile is changing, and most investors are acting like nothing has changed. Meanwhile, something even bigger is happening underneath the surface. Household wealth continues exploding higher. Bank of America estimates U.S. household equity wealth is already up $6 trillion this year, following gains of approximately $10 trillion in 2025 and $9 trillion in 2024. Think about those numbers. Now, that doesn't mean history repeats itself, but it does mean the risk profile is changing, and most investors are acting like nothing has changed. Meanwhile, something even bigger is happening underneath the surface. Household wealth continues exploding higher. Bank of America estimates U.S. household equity wealth is already up roughly $6 trillion this year, following gains of approximately $10 trillion in 2025 and $9 trillion in 2024. Think about those numbers. That is wealth creation on a scale that few people fully appreciate. And that creates what Bank of America calls a wealth price spiral. People feel wealthier, people spend more. Spending supports growth, growth supports earnings, earnings supports stock prices. Higher stock prices create more wealth, and the cycle feeds itself. Sounds bullish, right? It is, until inflation starts accelerating again. Then the exact thing that fueled the boom becomes the exact thing that threatens it. And that is why understanding second-order effects matter the most. Most investors only look at a price. Professionals look at cause and effect. Now, here's where things become even more interesting. The Bank of America bull and bear indicator currently sits at 8.7, which is firmly in sell signal territory. Historically, there have only been 17 similar signals since 2022. Average drawdowns afterwards weren't catastrophic, but they were meaningful. Typically 2 to 3% declines over the following months, with some periods seeing drawdowns as large as 15 to 20%. Now, before people panic and start screaming crash, that's not what the signal means. What it means is that optimism is becoming crowded. Everybody's leaning to the same side of the boat. And when positioning becomes crowded, markets become fragile. The strongest rallies don't happen when everyone is bullish. They happen when everybody believes. That is a distinction most investors never learn. Another fascinating development is happening globally. You look at the currencies. The Korean won is approaching levels associated with major historical crises. The Indonesian rupiah has reached record lows. Multi-emerging market currencies under pressure. That tells us global liquidity isn't flowing evenly. Stress is emerging underneath the surface. And when liquidity tightens globally, speculative assets tend to feel it first. Not always immediately, but eventually. That is why macro matters. That is why capital flows matter. That is why simply staring at a crypto chart without understanding the broader system can be dangerous. Because crypto doesn't exist in isolation. It exists inside a global liquidity framework. Now let's talk about one of the most overlooked pieces of data. Private clients at Bank of America. These are not retail traders gambling with rent money. These are wealthy investors managing trillions. Current allocations are 66.1% in equities, 17.2% in bonds, 9.6% in cash. Equity exposure is sitting near record highs. Bond exposure is near cycle lows. That tells us something very important. The smart money is still participating. They're not hiding in bunkers. They're not expecting the world to end, but they are becoming more selective, more tactically, more data-driven. And that distinction matters because there's a huge difference between being bullish and being blindly bullish. And one of the biggest mistakes investors make is assuming every correction is bearish. Many corrections are actually opportunities. The market transfers assets from emotional participants to patient participants. That's what it has always done. The crowd buys strength. The professionals buy value. The crowd buys narratives. The professionals buy mispricing. The crowd reacts. Professionals prepare. And when you study history, you realize the largest fortunes were rarely built by chasing what was popular. They were built by identifying what was misunderstood. That's why I spend so much time studying liquidity, ladies and gentlemen. That's why I spend so much time studying flows. That's why I spend so much time studying positioning. Because price tells you what happened. Flows tell you what is happening. And understanding the difference changes everything. See, when billions move into cash and when bonds receive record inflows, when inflation pressures begin reappearing, when positioning reaches extreme optimism, when global currencies begin flashing stress, you don't ignore those signals, ladies and gentlemen. If you do, you get cut up like sushi. You study them. You prepare for them. I tell you, this is all I do. I'm born for this. You build a framework around them because opportunities don't appear randomly. They emerge when preparation meets dislocation. And if dislocation appears over the coming months, investors who've done work beforehand will recognize them immediately. Everyone else will be reacting after the move has already happened, unfortunately, and getting cut up like sushi. That's the difference between following markets and understanding markets. So the key takeaway is that we're following. And again, ladies and gentlemen, if you want to understand how to take advantage of this and you're looking to want to learn how to trade and take advantage of all the markets, come and join the Crypto Public Desk monthly inside of our Patreon. One tip from the pits can pay for your entire year subscription. Join over 560 active traders and investors. 122 billion flowed into cash this week, while bonds attracted a record 39 billion, showing institutions are becoming more cautious. Crypto's experienced its largest outflow since late 2025. 46 out of 68 global central banks remain above inflation targets, suggesting inflation risks are not fully resolved. U.S. household equity wealth has increased by roughly 25 trillion over the last 3 years, fueling economic strength but potentially reigniting inflation pressures. Bank of America's bull and bears indicator remains at extreme 8.7, sell signal indicating excessive optimism and crowded positioning. Global liquidity conditions are becoming more important than individual narratives or headlines. What I'm watching, and anyone that retains any capacity is watching. Again, U.S. inflation data and whether CPI continues accelerating, long-term treasury yields, especially the 30-year bond, institutional fund flows into cash, bonds, equities, and crypto, global currency weakness, particularly in emerging markets. Watch the Korean won, Indonesian rupee, liquidity conditions and credit market stress, whether risk assets continue rising despite increasing stretch segment, signs of capital rotation to overlooked sectors and undeveloped opportunities. Why this is important to me, my own opinion, and anyone who takes any capacity, not financial advice. Because markets are entering a period where macroeconomic forces may become more important than narratives. If inflation remains elevated, central banks may be forced to stay tighter for longer. If liquidity tightens, speculative assets could face pressure. If positioning remains crowded, even minor disappointments can create significant volatility. But ladies and gentlemen, volatility is not something to fear. For prepared investors, volatility creates opportunity. The next major winners will be likely identified not by chasing headlines, but by understanding where liquidity is moving, where capital is flowing, and where the market's mispricing risk and value. See, the people who understand those dynamics before the crowd usually don't need to chase opportunities. They're already positioned when everyone else finally noticed. Ladies and gentlemen, this content is not for financial advice. It's for entertainment and educational purposes only. Always do your own research. Please. See, ladies and gentlemen, the times are changing. It's what you do when the chips are down that matters. It's what goes on in your mind. Your mind's a battlefield. You got to be its general. As always, ladies and gentlemen, I love you all. I'm going to see you on the front lines tomorrow, 10 a.m. ICP, 3 p.m. XRP. Remember, ladies and gentlemen, the ones who positioned early, not randomly, but intentionally, because some moments in history are loud, but the ones that change everything are quiet, right up until the moment they're not. And this is one of those moments. Do not blink, because the world is distracting you with noise while XRP continues, developing behind the scenes and building momentum in the broad digital asset landscape. Stay sharp, stay informed, accumulate knowledge. If you move now, be remembered. This is not the end of the story. This is just the beginning. This opened your eyes, smash that like button, ring the bell, and leave a comment with your thoughts. Turn on notifications, and most importantly, subscribe to the Crypto Public. We break down the major global banking trends shaping digital assets today, giving you content, clarity, and research you can use. Don't just watch history happen. Stay informed, stay ahead, stay in the public. I love you all. Have a blessed evening. I'll see you in the front lines.